Well, good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I have a really interesting entrepreneur to introduce you tonight, Larry Krauss. He is the founder, president, and CEO of Terracap. Terracap is a group of companies that have been developing real estate for a couple of decades in Canada. And I want to understand exactly what Terracap is all about. They've got a unique investment philosophy. And so I want to introduce you to Larry. Larry, how are you?
I'm good, Brian. How are you?
Excellent. So let's start off with, when did you found Terracap and why?
Well, Terracap is kind of a branch off a law practice that I started in 1980. So essentially, when I opened up my practice, it was focused on income tax and real estate and the integration of the two into tax advantage real estate investments. And I acted for many, many entrepreneurs, putting together, at the time it was called MERBs, which were multiple unit residential buildings that were had certain tax enhancements associated with them. And then we eventually were able to synthesize the same type of structures in both Canada and the US by applying different features and factors to each project to enable us to do that, both in Canada and the US. So we're allowing Canadians to invest in US properties and US residents to invest in Canadian properties. So we built an interdisciplinary cross-border law firm of about 14 lawyers through the 80s. And because people associated with looking for tax advantage investments are generally high net worth individuals, a number of high net worth families came to me and asked me if I could actually set up deals that we would run and they would invest in. And that's what we eventually did in the latter part of the 80s. And suddenly I'm getting phone calls about roofs and walls and windows, and I was busy practicing law. So I set up the predecessor of Terracap, a company called Syndicate Management, in 1989, brought in a CEO to run the company, and I continued to practice law. But that was the beginning of Terracap, essentially in 1989.
And Terracap today is how big?
So Terracap is growing. So I don't keep track on a regular basis of what we have, but essentially it's about $2.5 billion of assets and somewhere between 4 to 4.5 million square feet of actual space.
And what type of space?
So because we came at it from the tax point of view, from a tax perspective, it really didn't matter what asset type it was. So we ended up investing in all types of assets. So essentially we're agnostic. And we have assets that are industrial, land, hotel, retail, commercial, office, residential. So we are across the spectrum.
And across Canada and North America?
Across Canada and the US. About half of our portfolios in each jurisdiction, and we've been actively trying to find some projects in Israel as well.
Oh, really? Excellent. Whereabouts in Israel?
So we're currently working on a project in Rishon LeZion, which is on the coast of Israel, just south of Tel Aviv, and that would be an assisted living facility. And we love the Israeli model for assisted living. And so we've been looking at a number of opportunities in that area.
How is the model different in Israel than here in Canada?
It's actually radically different. Both in Canada and the US, somebody who's looking to be part of a facility will essentially rent a unit and pay a premium to what might be conventional rent in order to have the additional services associated with assisted living facility. In Israel, if you don't rent a unit, you occupy a unit, and as consideration for the right to occupy that unit, you deposit with the developer an amount equal to the fair market value of the unit. So if it was the equivalent of a condominium unit worth $1 million, you would put you would give $1 million to the developer, and that would entitle you to occupy the unit, paying all carrying costs associated with the unit, but effectively not paying any rent.
So it's as if you were owning the unit. It's like almost like a condo.
Right. So from a developer's point of view, it's as if he sold the unit, but he hasn't sold title to the unit. So effectively, when that person leaves the unit, you give back the deposit less a certain amount for depreciation, and the developer then has that unit to resell, so to speak, or to give an occupancy license to a new person. So it's an attractive, very attractive model, because effectively it lets you get your capital out of the, your capital investment returned on a fairly quick basis once you're stabilized.
And I guess for the resident, it would be like buying a condo, but you wouldn't get the appreciation.
Sorry, I lost you there. Please.
I'm saying for the resident, it would be like buying a condo, because you're out a comparable amount of money as you would if you had bought a condo, I presume, if it's the fair market value of the unit, but you're not getting any kind of appreciation. You're actually getting depreciation.
Right. And I assume that developed because of tax laws in Israel. Like, I haven't looked into the genesis of how this model evolved in Israel, but from what investigation I have done, it appears to be tax related.
Fascinating. We're talking tonight with Larry Krauss, who is the president and CEO of Terracap, a property development company here in Toronto with assets across Canada, the United States, and looking in Israel. We're going to take a break for some messages and come back more with Larry in just a minute. Stay with us. Welcome back to the Brian Crombie Radio Hour on Saga 960. As any of you that have listened to me before know, I interview every week an interesting business individual. And today I've got Larry Krauss, who is the founder, president, and CEO of Terracap, which is a property development company here in Toronto with assets across Canada and the United States and looking in Israel. And it sounds like it's an interesting firm, Larry, because as you've described, you're agnostic to investors, to investments. You invest in shopping centers, power centers, residential, both multifamily residential as well as single family residential in a couple of cases, and office and industrial, commercial, as well as condos. So you're really investing in almost anything. And you said that you were doing this because you were looking for tax advantaged investments. Tell me how you get the tax advantages.
Well, that was the origination of the firm. The tax advantages that used to exist, and to some degree still exist, but on a much lesser scale, enabled a developer to have really two sources of income. It enabled the developer to have the income from the property itself once developed, or if it was income producing, from the income that was in place. And it also took by selling the tax advantages to retail purchasers, it enabled another stream of cash, which was the equivalent of the tax savings experienced by the limited partners or the investors in the tax shelters. Today, that is less prominent, and now it is really much more based on the real estate itself. So we are, and have always been, but to extent more so now, focused only on the real estate. And to the extent there are tax advantages, we'll try and structure a deal to maximize the tax advantages. But the real estate has to make complete sense on its own footing.
I guess one of the benefits of investing in real estate has always been that it's leverageable, and most of the time more leverageable than a lot of other investments that people might make. Is that not true?
Very much so. So essentially your equity might be limited to 25% or 35% of your investment, but your appreciation is based on 100% of your investment. So in combination with the income that's generated from the property and the appreciation that takes place on 100% of the asset, the returns generally tend to be very, very attractive, usually double digits or more.
And if a lot of the annual income goes to operating expenses and interest, you're not making that much money that you got to pay full income tax on. And a lot of the return is going to be in the capital appreciation, which you would get a capital gains tax rate of. Is that correct?
Right. It's right. It's twofold. So essentially, because you have depreciation, you're offsetting tax on the income itself, on your current income. And then you have the advantage of capital gains on the appreciation of the property, assuming you've bought correctly. Unfortunately, a lot of money goes into real estate, but it's badly invested. So it's not a GIC, and there's no guarantee. And people do lose money on real estate even when prices rise.
But cap rates, which would be the capitalization rate, the return that someone is demanding on a set income from a property, have declined fairly precipitously with interest rate declines, have they not?
They have. Cap rates are generally very closely tied into interest rates.
So while it's not a GIC, you're not making a lot of money if you're investing just at the industry standard cap rate today.
No, but that's right. So in other words, we won't invest in a standalone Shoppers Drug Mart for 10 or 20 years. We're generally looking for value-added opportunities. So for example, it's been badly managed, or it's there's an area that's going to be better in 10 years. So we'll buy in that area because of the trends. We'll look at both trends and markets, and tend not to buy at very, very low cap rates.
So I used to be in the private equity business, and the way that I would sort of describe what you're doing is a private equity person would come in to a poorly managed or an undervalued asset and add two things. Number one, strategic value by somehow re-engineering, repurposing, improving the management of or the industry competitiveness of the company. And then second of all, often adding the leverage, both of which would add to value. Sounds like you're doing sort of the same thing in real estate.
We are, but remember, if the cap rate is low and your leverage is amortized, your cash flow can be close to nil. So you've got to either be buying a property that will have tremendous capital appreciation because of either value add through rezoning or value add through the areas trending towards gentrification or to higher values, or you've got to feed the property if you buy at too low a cap rate.
Yeah, so
leverage.
I guess the big difference between what you're doing and a private equity firm buying a poorly managed business is, as you say, you're financing it with mortgage type debt, and so therefore you're paying principal off every year, versus the typical financing for a company doesn't amortize, would have a balloon repayment at the end.
That's right. Generally, it's harder to get interest-only mortgages in real estate. The lenders typically look for some form of amortization.
So give me a sense, if you could, of some of your assets across Canada and the United States.
So let's start in the United States. We have focused in the United States on multifamily, commercial land, retail land in Southwest Florida, and a number of what I call bond type leases, situations that you've leased long-term to the government or long-term to an investment grade tenant. So bond type lease is a lease where it's called a hell or high water lease. So effectively, it doesn't matter what happens to the property. It can be destroyed, attacked, whatever happens, burned down. The government, or in that case the government, but in other cases an investment grade company, must continue to pay the rent. So there is no risk to the stream of cash flow coming from the lease.
And what would be the difference between a bond type lease and what I think lots of people would understand as a triple net lease?
Well, a triple net lease has exclusions. So it may not have exclusions for repairs and capital and maintenance, but it will have exclusions, for example, in this situation, if the building burns down. You generally will have to replace it or repair it within a 6-month period or a 12-month period, but if you don't do so, the tenant can terminate the lease. In a bond type lease, the tenant can never terminate, whether you repair it, rebuild it, or not. The government is responsible, or the tenant is responsible for ensuring that the building is repaired and replaced.
So that's interesting. So in a triple net lease, the building insurance would be something that would be funded by the landlord. And in a bond type lease, the property insurance, the building insurance would have to be in place and funded by the lessee. Is that correct?
Well, they're funded in both cases. They're funded by the tenant. The tenant in a triple net lease will pay for the insurance as they would in a bond type lease. But in a bond type lease, there'd be no exclusion if insurance proceeds weren't available, or if insufficient insurance proceeds were available to replace the building or rebuild the building. It would be up to the tenant to make up the difference. So the tenant could walk away from the lease, but it would still be on the hook for that 10 or 15 or 20 years.
You know, it's interesting. I'm trying to think about your the phrase you used, hell or high water. Do you know what the derivation of that is?
In terms of bond type leases?
No, where does it come from? Because it actually is pretty descriptive exactly of what you've described.
Right. Well, it covers both extremes. It's down below hell, high water, way above. So there's nothing in between that lets the tenant off the hook.
I'm going to have to Google to find out where it comes from. Okay, so that sounds interesting. And you said Southwest Florida. You know, why Southwest Florida rather than Florida?
Well, generally, no, Florida itself would be of great interest to us, but we haven't been able to find opportunities on the east side of Florida that made sense, that we've closed on. We've done some in the past, but not recently. And we generally try and work with a local partner, and a very good partner of mine lived in Southwest Florida, so he was identifying opportunities for us, just as we have a partner in Texas identifying opportunities for us there, and likewise in Kansas City.
Do you work with local partners a lot?
We do, especially in the US. We try and have somebody on the ground that we trust and are close to help us source deals.
I understand you've got some exciting condominium developments in downtown Toronto. Is that the case?
Yes, we have two very high profile projects in downtown Toronto. One of the southeast corner of King and Spadina. That will be a 45-story tower, hopefully with a mixed use to include a hotel or some other income producing use in the podium. And we likewise have a 38-story tower just off the southeast corner of Yonge and St. Clair.
Yonge and St. Clair, you know, doesn't have a lot of high residential development yet, but lots coming. Is that going to be sort of a new nexus of development, do you think?
I mean, Yonge and St. Clair is going to be a wonderful pocket. I think it will compete favorably with Yorkville and other high-end pockets, Rosedale, Summerhill. Yes, I think all the 5 or 6 projects that can go into that area, because it is fairly constrained in terms of land area, are going to tend towards the higher end and tend to be iconic, tend to be high profile and iconic, as will our project.
And so yours will be a fairly high-end project.
It will be a higher end project. So it'll have quite a number of units. So it won't be a luxury, super luxury building in the sense of a boutique building of 150 units. It'll likely have in excess of 300 units, but it'll be higher end, more outdoor living space, more higher end amenities. It will be an exceedingly attractive project.
My daughter just got a condo on King West, and that area is just going crazy. It appears to be on fire, but primarily with younger people. What's your development at King and Spadina going to be like?
So we're hoping that will include a hotel, a mid to upper scale hotel that will also animate the area with restaurants and entertainment. And will provide services to the condominiums above. That's our hope. It depends, of course, on the economics and on the hotel company that will be interested in operating a hotel there, and ourselves, to the extent we're interested in owning that hotel. But essentially, that is our goal. Our goal is to take that southeast corner of King and Spadina, which we consider the gateway to downtown West, and do something very exciting there.
There seems to be a fair amount of hotel development, luxury hotel development down there. You got the Bisha Hotel, you got the Thompson Hotel, you got the Ritz-Carlton. Is there room for more?
Based on what we've seen, the demand, again, COVID aside, but assuming COVID is dealt with and becomes more of a historical anomaly than anything else, there are not an excess of hotel rooms in the city of Toronto, particularly in that area. And most of them are boutique, smaller hotels. And it is also an area that is up and coming. You have the well going in there. You have all the development along between Spadina and Bathurst. You have the one hotel opening at King and Bathurst. So that whole area, I think, will also be an alternative, not similar in character, but an alternative to Yorkville. So when people come to stay in Toronto, they'll think of Yorkville, they'll think of King West. So we think the demand is strong for hotels in that area.
The Bisha and the Thompson both have really good bars and rooftop patios with pools. Are you going to have anything like that?
We will have a speakeasy and that'll be underground, and we'll also have 2 restaurants, including rooftop bar.
With a pool?
And with a pool. Yes.
Awesome.
Yes, but again, it all needs to be completed, and all the capital needs to be put together to make that happen, and that's what we're working on now.
But it is amazing. I interviewed a gentleman that does these visual pictorials of the skyline of Toronto, but does both existing as well as all the buildings that have been proposed, either permitted and or just proposed. And it's amazing what's going to happen in the next decade in downtown Toronto. The amount of building, and it's going to be just spectacular, and it's going to be exciting for you to be part of it.
We're excited to be part of it.
I'm interviewing Larry Krauss, who is the founder, president, and chief executive officer of Terracap tonight. We're going to take a break for some messages and come back more and find out a little bit about how people invest in Terracap. Stay with us. Welcome back to the Brian Crombie Radio Hour. We're chatting about real estate tonight, real estate development specifically, with Larry Krauss, who is the founder, president, and chief executive officer of Terracap, a real estate development company here in Toronto, with developments across Canada, the United States, and looking in Israel. And it's interesting, some of the developments in Florida and Texas that he's described, as well as condominiums in downtown Toronto, sound quite fascinating. And Larry, I understand that you've got a big development that's sort of a resort or recreational facility in British Columbia. Tell me about that, if you could.
So there's an outstanding location just outside of Victoria, which is almost part of Victoria, and that's called Bear Mountain. So we've acquired 2 sites within Bear Mountain. The first will be a condominium building of 209 units. And the second will either be a condominium or rental building. We're still studying the alternatives, of 150 units within the village of Bear Mountain. So the first project is we're just positioning it for marketing now, and we're just finalizing the name, so I won't give you a name at this point, but it'll be 209 units that are already under construction. So essentially the podium is built. We're doing the seismic work on that podium now, and we will hope to go to pre-sales at the end of this month or the beginning of June, and begin construction sometime in March 2022.
Now, Bear Mountain is known not for skiing, but for golf. Is that correct?
It is known for hiking, biking, tennis, golf, tremendous recreation. It is an exclusive and possibly the only urban resort within Canada.
Urban resort, what do you mean by that?
So as opposed to a resort let's say like Collingwood, where you'll drive 2 hours from Toronto to get there. This essentially is 15 minutes, 20 minutes through the Trans-Canada route from downtown Victoria. So
And you could live on
effectively,
a
it's
mountain.
like living in the city and living on a mountain in the city.
Fantastic. And the
Yes.
golf course is a Jack Nicklaus golf course.
It is it's 36 holes. It's actually 2 golf courses, and reputed to be the best in the country.
Fantastic. And then the balance of your development across Canada is what? Shopping centers and some airport facilities?
So in Canada, we have a number of retail centers across Canada. Just going to shift this a little bit. Hopefully that will try and getting the light off my face, but I don't seem to be able to. So we have a series of grocery anchored centers across Canada, essentially from Quebec, from Montreal through Vancouver Island. And we have a number of office buildings, a number of a couple of airport facilities, including a facility that we leased to Air Canada, another one that we leased to DHL and Purolator and Cargojet, right on the runway of the Edmonton International Airport. And that's our focus in Canada: condo development and income producing properties.
What do you think some of the trends are in real estate? Maybe just start with Canada. We've had a lot of people that have been moving out of downtown into the suburbs during COVID-19. Do you think that's going to continue, or are people going to move back downtown? And the condo business, you must be positive about with your 2 developments at Yonge and St. Clair and King and Spadina.
Well, it's an interesting question. Behavior will change for some time. We're not out of the COVID pandemic at this point. Hopefully 6 months from now, it will be less of an issue. And a year or 2 from now, maybe non-existent. But I think behavior will take root. The behaviors that changed during COVID will continue. There'll be certainly a lot more remote work, a lot less business travel. But people want to live where there's culture, where there's restaurants, where there's recreational opportunities. Downtown, St. Clair, those are areas which would offer both. I think that with immigration slated to increase dramatically over the next few years in Canada, I think the demand for housing both downtown and in the suburban and ex-urban areas will continue to grow. I think real estate will have a powerful tailwind behind it.
Housing prices, I think, as a multiple of income or of rents are at an all-time high, comparable to where they were in the United States prior to the 2008 collapse. Cap rates are at an all-time low. Do we have a real estate bubble in Canada?
It really depends on interest rates. If the U.S. government lets inflation get out of hand, really, if the Reserve, if Powell doesn't do something to tamp down the amount of stimulation in the U.S. economy, inflation will take off. And the only way to correct that, I mean, there may be other ways to correct it, but historically, the way to correct that is with higher interest rates. Higher interest rates are the death knell for most real estate investments. And that is a risk that bears watching very, very closely right now. Interest rates are trending up.
So the yield curve is up 100 basis points in 4 years, 200 basis points in 10 years. Is that kind of an increase a problem for you?
Not at this point, but I'm talking about much more substantial increases. If rates go up, 10-year treasuries are now 1.5 and they go to 4.5, that 300 basis point increase, that will damage the economy tremendously.
Right. So when the 1920s, coming out of the Spanish flu in World War I, which was obviously far more traumatic and lethal than our current pandemic, but the best comparable. We entered 9 years of an unbelievable boom market, and people came out of their isolations and the Spanish flu and went crazy, and it led to the end of prohibition, speakeasies, and then the end of prohibition. A huge amount of investment in restaurants and downtown living, and Great Gatsby was sort of the icon of the era. Ended 9 years later in 1929, obviously, but it was 9 years of an incredible bull market. What do you think? Is that going to happen again?
I think there's no question there's a bull market happening. And you can see it already in the US, where even though the last employment report at the beginning of June, employment rose, I think it's just a matter of time before all the pent-up demand expresses itself in restaurants, in travel, in goods and services. So there is very little doubt that households have built up a lot of income, especially with the stimulation programs in the US and in Canada as well, where people have not had opportunities to spend their capital, that they're looking for that opportunity to spend their capital. As I say, the only potential cloud on the horizon is interest rates. And if the government has to clamp down and mortgages become very expensive, then that will have the opposite effect.
So let's talk about that then for a second. What's a hedge against interest rates? Historically, gold has been one hedge against interest rates and/or currency deflation. But I thought real estate usually is a hedge against interest rates because because real estate over the course of the last couple of generations has done better than inflation and has been a hedge against interest rates increases. Is that not the case?
Real estate has generally been a great hedge against inflation, but it depends how much leverage you have. If you're over leveraged on your real estate and suddenly you've got 65% or 70% leverage and your interest rate goes from 4% to 8%, that will bring the value of real estate down. So
sounds like it's time to lock in long.
Well, that's the beauty of real estate. If you can pick longer term rather than short term mortgages, then you can hedge against the next negative down cycle.
So Terracap is not a public company. How do you get your investors?
Essentially, it's by word of mouth, by invitation, by people who've reached out to us and said they're looking for opportunities, and through different sources, different referrals of different sources of capital. We haven't gone after institutional capital. It is something we're thinking about doing because they're long-term investors in real estate, and our interest is long-term investment in real estate as well. So we are not interested in buying properties just to flip. We recently bought the corner of Bathurst and Steeles, an 8-acre site that we've received offers in excess of $10 million more than what we paid for it already. But that's not the way we work. Even though we could make a quick profit on that and return almost 60% on our equity, almost 70% on our equity very quickly, it's not what we look for. We're long-term investors in real estate. A site like Bathurst and Steeles, which is slated for 1.2 million square feet of development, we think has a very good, way better prospects than just flipping a property. So to come back to your question, what type of capital we look for capital that's patient. We look for capital that will take a long-term view of what could possibly happen in a particular site, to a particular site in a particular area.
But people are investing that invest with you on a project by project basis, not in all of Terracap. Is that correct? That's
right. We effectively are a REIT, but every investment is separately siloed. So you want to invest in a project in Vancouver, but you don't want to invest in a project in Toronto. You have all the upside and downside of the project in Vancouver. You're not impacted by the project in Toronto, and vice versa. So you're not hurt by a investment that didn't go well. You're not boosted by another investment that did go well, you've chosen which investment you're going into. And what a lot of our investors do is just invest across the board.
And you said you're effectively a REIT. Can you explain to everyone what is a REIT and what it stands for, and how you're effectively a REIT?
So a REIT is a tax structure that essentially enables the cash flow of the property to flow directly to the investor. So there's no two tiers of taxation. So essentially, so some people invest in corporations that own real estate. The income from the real estate is taxed in the corporation, and then it is dividended out to the investor, and they are separately taxed on the dividend. And there's mechanisms for reducing the double taxation. A REIT is like a pipe that flows the income directly from the investor to the unit holder. So we'll set up a structure like a co-tenancy or a partnership, and the co-tenancy is our preferred form for income producing real estate, and it allows the cash flow to go directly to the owner of the co-tenancy interest. So they're a unit holder in the real estate itself.
And the benefit is you're getting rid of one level of taxation. Are there risks?
No. Let me answer the question in two parts. We'll use a limited partnership in a situation where we do feel there is a risk. It has most of the advantage of the co-tenancy, but it has some aspects that are not as attractive as a co-tenancy. But given the insurance it provides in terms of liability, in a development deal such as King and Spadina or Yonge and St. Clair, we'll use a limited partnership to protect investors. In a property that's an income producing property where you have insurance for any risks and you're not highly leveraged, we'll use a co-tenancy. We don't believe that there are any risks to the investors in those transactions.
Larry, I'm not sure if most of my listeners are going to be familiar with what a co-tenancy is. Could you describe that, please?
Sure. A co-tenancy is where you have a group of owners, say 15 owners, and they enter into what's called a co-tenancy agreement, where they are co-tenants in that property. So let's make it simple. Let's say there are 10 owners and they each own 10% of the real estate property that's being purchased. So they form a co-tenancy in which they each own 10% of the real estate through this vehicle called a co-tenancy. The co-tenancy is not separately taxable. It exists from a legal point of view, but it does not exist from a tax point of view. So effectively, from a tax point of view, the income flows directly to the individual that is a co-tenant. From a legal point of view, the co-tenancy agreement governs the relationship between the co-tenants and its ownership of the property.
Now, if you own 10% of the co-tenancy, do you own 10% of the liabilities or 100% of the liabilities? There's this term about joint and several risk. How does that apply in a joint tenancy versus a limited partnership versus a corporation?
So that's a great question. So what we do is we limit the risk of a 10% co-tenant to 10% of the liability. And we do that by obtaining non-recourse financing, non-recourse leverage, or to the extent there's recourse, we have a guarantor provide the covenant, but have only the right to be indemnified to the extent of an individual co-tenant's share of the property. So that 10% owner is never liable for 100% of the leverage. They can only be liable for their 10% of the leverage or 10% of any other risks in the deal.
What about in bankruptcy, or if there was an environmental problem or something like that, where the creditors want to go after all of the owners? Can they go after each one for 100% of the liability, or are there again limits to only getting the 10% liability?
So we always put environmental insurance on all our sites. So that's governed by insurance. As I say, we insure any risks that can affect the co-tenants. And in terms of bankruptcy, that's why the financing is non-recourse. So the lender who has priority in terms of recovery can only go after the property. Their recourse is limited to the property or to the guarantor.
How does a tax lawyer become such an expert in real estate?
I always considered it a privilege to be a lawyer, especially with the clients I was working with. They were highly entrepreneurial, and I considered it my responsibility to know their business as well as or better than they did. So in my approach to law, I really immersed myself in understanding their business, because only by understanding their business fully could I draft the contracts and provide the structuring and provide the input that could be real value added to them. So as a result, I learned from some of the best in the field and ended up with a great deal of knowledge about real estate. And now I stopped practicing law in about 2005, even though I maintain my license. And I focus full time on the investment side of the business, which is both operations and investment side of the business.
I understand that you said that you are agnostic in your investments and opportunistic in what you're investing in. I used to work for Jim Pattison, a $7 billion billionaire, self-made all by himself. And he had a couple of adages that I liked. One of them was that whenever he made a decision, he would make the decision, but then sleep on it and decide it again the next day to see if it was the exact same decision or whether his mind had changed overnight. And the other thing is he would hire smart people like me that would do a whole bunch of financial analysis, but in the end, he wanted to just know what his payback was, which was sort of his personal judgment that could override a lot of the more detailed financial analysis, and he had the benefit of both. When you're making decisions, how do you make decisions that have led to your success today?
I also do something similar to Jim Pattison's approach, in the sense that I'll make a decision, but if it's a major decision, I'll sleep on it and mull it over in my mind many, many times to make sure I'm making the right decision. I never willy-nilly just jump off a cliff. But also, it's as you put it, it's vital to have a very, very good team of people who are analyzing the deal and thinking about it, and are not yes people, but are pointing out the risks, pointing out what they like, what they don't like about the deal. And so it's very important to have a dialogue, people you can dialogue with about whether a deal makes sense or it doesn't make sense. So it's really a question of synthesizing all of the information that's possibly available. We do tremendous amount of due diligence on every deal we work on. And with all that information, we try to ensure we make the right decision. We opened up an assisted living facility in Sarasota just recently. Had I known that COVID, we did that deal 6 months before COVID or 8 months before COVID appeared on the horizon. Had I known, maybe I wouldn't have done that investment. I mean, in the end, I think it'll turn out just fine, because in the Sarasota area, there's a tremendous amount of demand for ALF and memory care. But you can only make a decision based on the information you have. You can't have 100% foresight as to what will happen. And there's nothing wrong with making mistakes, as long as you learn from those mistakes and adapt and grow.
What's
so
your
we're
vision?
we're not afraid of making mistakes as well.
What's your vision for Terracap in, say, 5 years? And frankly, what's your vision for Toronto real estate in, say, 5 years?
I think that we want to build on the expertise we've developed over the last 3 decades and grow in the areas that we think make sense to grow in, such as assisted living facilities or independent living facilities. There's a focus on that. There's a focus on airport properties. There's a focus on condo development. What I like about Terracap's approach is that we're not just living in our own backyard. We feel very comfortable in other backyards as well. So if we determine that Toronto is going to become a no growth area, not that I believe that at all. I think Toronto's got tremendous future prospects. But if I did for a minute believe that Toronto is going to go dormant in terms of growth, we would be comfortable in San Francisco or Oakland or Dallas or other markets or Israel, or we've looked at deals in Europe. We're not afraid to look for opportunities in many, many different markets. And we're not afraid. We keep our ears open as to where those opportunities might be, where those trends might be.
Would you invest in downtown Manhattan?
We're looking at 2 projects now in Manhattan, one in the Upper West Side and one in downtown Manhattan. And the reason we're looking at them in the case of Upper Manhattan, it's because the market is so dreadful there for luxury condo units that and we see an opportunity to get in at a very, very attractive cost base. So we like to look at markets that are beaten up, and Manhattan is one of those markets that is beaten up right now. So absolutely, we look for opportunities in places where we think the market will turn around in due course.
If some young person, guy or gal, was listening today and said, I want to be Larry Krauss, or I want to be the Reichman brothers or whatever, and I want to build a great real estate development company, how would you say they go about it? What would you say they should do?
Well, I have to say, I found that law was a tremendous springboard for me into this area, but it isn't necessarily the only springboard. But having a good appreciation, whether you are a lawyer or you're not a lawyer, having a good appreciation of the legal complications, nuances of transactions, and how to structure them, and what to look for in leases and what to look for in contracts is really vital. But again, you can come through it as a planner, you can come through it as an architect, you can come through it as an engineer, as long as you have an exceedingly curious mind and you're interested in absorbing as much information as possible and immersing yourself in obtaining the information and the knowledge, you'll generally be able to succeed.
Curious mind and absorb what you find out and immerse yourself. 3 good adages from Larry Krauss, the founder, president, and chief executive officer of Terracap, a Toronto-based real estate development company involved in real estate across Canada and the United States and looking in Israel. Larry, thank you so much for joining us tonight.
Thank you, Brian.
Well, that's my show for tonight. I'm on every Monday through Friday on 9:60 a.m. at 7 o'clock. Early in the week, I have business people, economic people. In the middle of the week, often healthcare, and later on in the week, lifestyle. So please join me. And all of my webcasts are available on my website, briancrombie.com, on YouTube, and all my podcasts are available on my website, briancrombie.com, Audible, and Spotify. Please check me out. Thanks very much, everyone. Good night.